Good afternoon, my people. What is going on, Wealth Our Way Nation? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. I welcome each and every one of you to episode 154, Why the Amazon Stock Split Doesn't Matter to You. But before we get into all of that, let's practice the attitude of gratitude by me saying thank you, thank you, thank you to each and every one of you who are here with me live as I stream across the Wealth Our Way Facebook page and the Wealth Our Way YouTube page, the Wealth Our Way Network YouTube page. I also want to give the Wild Nation salute to each and every member of Wild Nation who watches this program pre-recorded overnight, over the weekend, wherever you can squeeze 15 minutes of financial literacy in, and then a heartfelt how are you to the good folks of the Life 101 platform who listen to the audio recording of this very here program. It has been too long since I've seen Wild Nation. I celebrated my 52nd birthday. I took 2 weeks vacation. Never did that before. 2 weeks of uninterrupted enjoyment, the chance to recharge my batteries, get focused, and find out what was important to me. And of course, what I found out was what I already knew. You're important to me. I missed you guys, and I'm glad to be back. This week is a promising week. We're going to have 2 episodes of 15 Minutes of Finance, today and Thursday, of course. And then tomorrow night, I got my guy, Kamari Ellis. Let me just tell you, I have shaped the Financial Power Hour to be a combination of information and education, some form of edutainment, as they call it. And I've had a lot of episodes this year where we've touched on topics that I know people want to deal with outside of finance, so to speak. But tomorrow night, we get into finance with a person who I trust implicitly when it comes to good financial information. This is someone who I brainstorm with, who I respect intellectually on the same level as myself. Kamari Ellis is everything when it comes to finance, taxes, investments. He puts the time in. He educates himself so that he can educate others. And he and I are going to have a candid conversation about all things economics, all things financial going on currently in these markets in this country and in the world at large, so that you guys can get educated. You guys can ask your questions. Most importantly, you guys can stop living in fear. I am feeling and hearing so much fear and concern about what is going on, because when you're not truly comfortable and truly armed with the proper knowledge and education, it's almost impossible to be comfortable with your next step. So Kamari and I are going to be on here tomorrow having a conversation and answering all your questions. Please join us tomorrow night, 6 p.m. for the Financial Power Hour. With that being said, let's talk about this Amazon stock split. It's in the news. Let's talk about the news, the financial news. I'm going to limit myself to the financial news because Lord knows I can't get into these social subjects that are going on right now. It's heartbreaking, some of the things that I'm seeing across the globe, especially in my dear city of Philadelphia and in these United States. So let's keep it to finance today. The Amazon stock split. I touched on this a little while ago. We talked about Tesla splitting. Let's start with what a stock split is. A stock split is a company determining that they are going to half. And in some cases, it's not just a half. A 2-for-1 stock split is half, but you can have a 3-for-1, a 4-for-1, whatever that number is. You're dividing one share of stock by that number, and you're creating a multiple of the already existing shares. What happens to your share or to the shares when a stock split occurs? You basically increase the number of shares out there and you decrease the price at which they trade. So the actual dollar amount of what a share is worth for you doesn't change. If you own one share of a stock and the stock is trading at $100, you own $100 of that stock. If they do a stock split, you're going to go from having one share to 2 shares. And the price is going to drop from $100 to $50. And 2 times 50 is the same $100 as 1 times 100 is. So nothing has happened in terms of your ability to have net worth. You still have the same $100. So then the question begs to ask, why do stock splits happen? There are many, many reasons that a company will split their stock, but those reasons over the course of time have come to change. I've told you this on a previous episode. One of the things I hope you guys respect and appreciate about 15 Minutes of Finance is that every episode that I've ever produced is still alive on the internet, and you can go back and check the consistency of what I have told you. When I became a stockbroker 25 years ago, you could not buy one share of a stock. You could not buy a partial share of a stock. There was a program out called DRIPs, and DRIPs still exist. They're called dividend reinvestment programs, DRIP, that individual companies have for their shareholder programs. But I'm not talking about DRIPs. I'm talking about you as a consumer deciding you want to own some Disney or own some Nike or own some McDonald's. You couldn't call your stockbroker up and say, give me one share of McDonald's. It just didn't exist. Every time you bought stock, you had to buy what was known as round lots. And round lots were 100 shares of a stock. So imagine you've been educated on buying stock. Somebody told you, hey, buy what you know, buy what you do every day, buy what you use every day. And you look at your body and you realize you wear Nike sneakers. You realize you go to McDonald's twice a week. You realize you go to Disney every summer for vacation. And you say, I'm going to buy some Nike. I'm going to buy some McDonald's. I'm going to buy some Disney. You call your stockbroker up and they tell you, great idea. Those are 3 American stalwart companies that are always going to be here. I'm ready to take your order. 100 shares of Disney is $3,500. 100 share of Nike is $4,000. And 100 share of McDonald's is $5,500. Please give me your check for $13,000. And you're like, I got $500. You couldn't do then what you can do today. Today, you can go to Charles Schwab, you can go to Fidelity, and they have fractional share purchasing, which means if you have $500 and you want to own McDonald's, Nike, and Disney, you give your $500 to Charles Schwab, and they proportionately buy whatever that amount of Disney stock is. You may end up owning 1/11 of a share of Disney stock. You'll see it on your computer as such. It'll say 0.11 shares of Disney, and they'll multiply 0.11 by whatever Disney is trading at, and that's what you'll own in your portfolio. It is a beautiful thing. They used to do stock splits because the price of a stock would get so high that the average person couldn't afford to buy 100 shares of it. So they would split it, let the price come down, and make it more attractive for the general public to invest in. That doesn't need to be the case anymore because of fractional share ownership. So why is everyone so excited about the Amazon stock split? There is no good answer because your ability to buy Amazon has not changed. You could open a Fidelity account and buy Amazon today the same way you could have bought Amazon 3 weeks ago, regardless of what the share price is. And if you have listened to previous episodes of 15 Minutes of Finance, you understand that the price that you see along the ticker on MSNBC or CNBC of a stock price is not truly what the value or the cost is. That's just the price. The price and the value are 2 different things. When you buy a stock and you want to determine the value of a stock, what you are truly doing, if you understand finance, and if you don't, please keep coming here, you are buying a company because you hope, you believe, you anticipate that this company will continue to make money into the future. What does make money mean in financial terms? That they will create earnings. They will earn money moving forward. Well, the way the financial world accounts for earnings and values a company, they use a formula called earnings per share. So if a company has 1 million shares outstanding and they earn $3 million, the earnings per share is 3 million divided by 1 million, and the EPS, the earnings per share, is $3. That is how you compare the value of two different companies. You compare their earnings per share. So one company can have an earnings per share of 3, another company can have an earnings per share of 5. The company that has the 5 earnings per share is a better company. It makes more money per share. But the price that you could pay for each company could be drastically different. The price on the trading symbol may make the company that's earning $5 only be a $10 stock to buy, whereas the one that's earning $3 could be a $50 stock to buy, because the general market determines the price of a stock, whereas the earnings and the fundamentals of a company will be reflected in the earnings per share. This is such an important lesson that I have decided to create a 1-hour webinar to teach people the difference between the price of a company and the value of a company. And actually, I'm going to enlist, he doesn't know this yet, but I'm going to enlist Kamari to help me with the webinar, because it's very important for me to get people to understand what they're buying and why. This leads me to something else. So I took a call from a client yesterday. And, you know, I never use my clients' names when I tell these stories, but if they're watching, they know I'm talking about them, and they hit me up later like, why are you talking about me? But this particular client called me. She wanted to buy Amazon. And I asked her, why do you want to buy Amazon? Because I am her financial advisor, and I know in her portfolio, we own the S&P 500 ETF, Exchange Traded Fund. And guess what is a component of the S&P 500? Yes, you're correct. Amazon. Amazon is I want to say, the third highest weighted company in the S&P 500. So if you own the S&P 500 index fund, ETF, whatever, you already own a piece of Amazon. I tell my clients, I don't like buying individual stocks. Tank is the boring investment guy. Individual stocks make me nauseous because individual companies come in favor and out of favor. What never, ever fails over time is the broad-based market. There are 507 companies in the S&P 500. Don't ask me why it's called the S&P 500, and there's more than 500 companies, but there's 507 roughly. The top 15 companies, that means 3%, the top 15 companies in the S&P 500 are responsible for 33% of the returns. It's very front-loaded. And these are companies you know: Apple, Amazon, Tesla, Google, Procter & Gamble, Facebook. These are the big boys that make up the S&P 500. If you want to be diversified, you want to own the S&P 500, you never have to own an individual company. It makes your portfolio not as diversified when you own individual stocks. We are going to talk about this a lot tomorrow night. I can't cover it in 15 minutes. So please tune in tomorrow night for a deeper dive in this conversation. My boy Bruce sent me an article today about Target missing its earnings number and the market taking a nosedive as a result. I want to talk about that tomorrow night. Target is the, I want to say, the 101st weighted company on the S&P. So why would the company that's 101 miss its earnings and cause the whole market to go down, when I just told you that the top 15 companies make up a third of the return? It's because of the individual and the institutional investors' mindsets. And we will talk about that tomorrow night on the Financial Power Hour. So tomorrow night is not going to be so much about entertainment as it's going to be about education. Bring your pads, bring your pens. We're going to get into it. I can't wait to see you guys. I thank you all for the birthday wishes. Thank you, Liz. It's great to be back. Remember, please join us tomorrow night. And what I always tell you is true: wealth is not only for the wealthy. I will see you guys tomorrow night.